Hello, I'm Andrew Myers from BHP Financial Planning Limited. We are independent financial advisors regulated and authorised by the Financial Conduct Authority. In this presentation, I'll be covering a range of topics around pensions and financial planning. In terms of the agenda, we will start by looking at some of the background information on why pensions have become such a hot topic. We'll then run through a quick overview of the NHS pension scheme, cover some of the tax issues around pensions, then look at the proposed reforms to public sector pension schemes, which has been grabbing such a lot of media attention over the last couple of years. And finally, we will finish off with an explanation of what, in my view, proper financial planning is all about. So why are pensions causing politicians, employers and individuals such a headache? In very simple terms, there are two main reasons. Firstly, as we are living longer, our pension funds need to sustain us over a much longer period. Secondly, the cost of providing pensions are linked to the investment returns on UK government bonds, generally known as gilts, and these returns are pretty much at an all-time low. So if we look at gilt yields and the annuity rates over the last 20 years, we can see how they've reduced, and we can also see the relationship between the annuity rates and the gilt yields. For example, a 65-year-old male retiring in 1991 with a £100,000 pension fund would have been able to buy a pension of almost £14,500, whereas in the current climate, the same fund would buy less than half of that at around 6,200. This table shows us how life expectancy at birth has changed over the last 100 years or so, with both men and women now expected to live 30 years longer. In 1926, around a third of all men and 40% of women could expect to live to age 65, whereas today, almost 80% of men and 85% of women can expect to reach this milestone. Therefore, it's hardly surprising that the government spending on the state pension benefits has more than doubled in the last 30 years. This problem is set to continue, as it's projected that in just over 20 years, almost a quarter of the UK population will be over the age of 65. And the way that statistics work, the longer we live, the longer we are expected to live. For example, according to the Institute of Actuaries, I can expect to live until I'm aged 83. But if I actually make it to age 83, then I can expect to live almost another 7 years. So what choices do we have? Hopefully, we can generally agree that living longer is a good thing. However, it has to be paid for by a combination of a number of things: working longer, saving more, or lowering our expectations. So that's some general background information on the cost of pensions. So moving on to the NHS pension scheme, I'll start with a very brief overview of how the NHS pension scheme works. It's a defined benefit, sometimes called final salary scheme, meaning you receive a guaranteed and inflation-proof pension based on your service and earnings history, together with an additional cash lump sum. As well as offering pension benefits, membership of this scheme also provides some life assurance and sickness benefits. Most of the cost of providing the pension is met by the NHS, with individual members paying contributions in between sort of 5 and 14.5%, depending on their earnings. In spite of what some people might say, compared to the vast majority of private sector pension schemes, the NHS pension is currently and will remain a high quality pension scheme. There are currently two sections to the NHS pension scheme, the 1995 section and the 2008 section. Generally, if you join the NHS pension before the 1st of April 2008, you will be in the 1995 section, and if you joined after this date, you'll be in the 2008 section. The main and probably most important difference between the two is that the 1995 scheme has a standard retirement age of 60, but with the 2008 scheme, it's age 65. This slide shows examples of how the pension and cash lump sum are calculated for general practitioners depending on which scheme they are in. In order to calculate your pension, you will need to know what your revalued career earnings are. The revalued career earnings are the total value of all of your earnings which have been dynamised or index linked into today's value. To calculate the value of the annual pension, this total earnings value is multiplied by the pension factor of 1.4 or 1.87% depending on the scheme that you are in. Moving on to the taxation changes affecting pensions. Clearly, the Treasury's overall aim here is to increase tax revenues as well as try and regain some control around the costs of public sector pension schemes. We'll have a look at why the changes have been made and how you may be affected by the new regime. In particular, changes to the annual and lifetime allowances. And then we'll finish off by looking at some possible planning opportunities. If we start by looking at the annual allowance, this is the amount of pension contribution input you are deemed to have made each tax year. This allowance now stands at £40,000 per annum, having recently been reduced from £50,000. It is possible that you can carry forward any unused relief from the previous 3 tax years. For example, if you are deemed to have made contributions of £45,000 in the current tax year, but have at least £5,000 of unused relief from the previous 3 tax years, you won't have any additional tax to pay. The method for calculating the value of contributions for members of defined benefits pension schemes such as the NHS pension scheme has changed from a factor of 10 to 16, and in the next few slides I'll walk you through an example of how this works. This change in the calculation factor effectively increases the value of your deemed pension contribution inputs, thereby increasing the number of pension scheme members whose pension contributions will exceed the annual allowance. In addition to the reduction in the annual allowance, the lifetime allowance was also reduced from the start of this tax year from 1.5 million to 1.25 million. However, there remain some ways of maintaining the previous higher lifetime allowances if certain conditions are met. Looking at the annual allowance in a bit more detail, this now stands at £40,000, up to which individuals should receive tax relief. Any excess payment above this figure will be taxed at the individual's highest marginal rate. If the tax liability is greater than £2,000, it is possible to elect for the scheme to pay the tax liability, but there are implications for choosing this option, mainly a reduction of the pension payable at retirement. The Treasury have introduced a carry forward relief to assist in reducing the tax implications from one-off spikes in pension contribution. But just how much is £40,000? It's easy for money purchase schemes such as personal pensions, stakeholder pensions or SIPPs, as you simply look at the amounts physically paid into the pension during the tax year. For defined benefit schemes such as the NHS pension, the calculation is more complicated as it's made with reference to the increase in pension value over the year, which is then multiplied by a factor of 16. Probably the best way to explain this is by looking at an example, which we'll do shortly. In terms of who might be affected by the changes, it's fairly obvious really. High earners, members with long service who experience sharp increase in earnings, members buying additional pension, added years, or also making personal pension contributions. This traffic light chart, which I've cut and pasted from the NHS Pensions website, is quite useful as you can simply use your year's service and earnings to give an indication as to whether or not you are likely to exceed the lifetime allowance. So let's have a look at an example. This is the most technical part of the presentation, so if we can get through the next few slides, it's all easy sailing from there on in. This example is for a 1995 scheme member with annual earnings of £150,000 per annum. The total career revalued earnings stand at 3 million. In this example, I've assumed CPI, or the Consumer Prices Index, is 3%. The first part of the calculation is to work out the opening value as at the 1st of April 2014. In order to do this, we start by calculating the pension value. In this example, this equates to 42,000. We then multiply this figure by the pension factor of 16. We add up the value of the cash lump sum and finally increase the total value by CPI, in this case 3%. This gives us our opening value of £821,940. We then need to calculate the closing balance. This is calculated in much the same way. However, you will notice that the career revalued earnings takes into account additional years' earnings between 2014-15 plus any dynamisation sort of factors that have been applied to the scheme. The pension input is a difference between the closing value and the opening value. The tax liability is charged on the excess value above the annual allowance figure, that being £40,000. Therefore, the tax is applied at the individual's highest marginal rate, which in this example is 45%, giving a potential tax liability of £5,341. We also need to be aware of any contributions being made into any private pension plans, as these will need to be brought into any calculations that we do. Moving away from the annual allowance and onto the lifetime allowance, the lifetime allowance effectively places a limit on the amount you can save within your pension schemes without you facing some additional sort of tax charges. Last year, the limit was 1.5 million, but this reduced to 1.25 million with effect from April 2014. The tax consequences of going over the limit is that the excess is charged at 25% if taken as income and 55% if taken as a lump sum. As far as how you calculate the value of your pensions with money purchase schemes such as personal pensions, stakeholder pensions and SIPPs, you simply take the value of the fund at the time benefits are taken. However, with defined benefit schemes where there is no actual pension fund, a formula has to be used to calculate the capital value of your pension scheme. Confusingly, as far as the pension amount is concerned, rather than using a factor of 16, they use a factor of 20 and then add on the tax-free cash lump sum. For example, if Jim's NHS pension was £58,000 per annum and his tax-free cash lump sum was £174,000, the capital value of his benefits will be £1,334,000, meaning he would face a tax charge on the excess of £84,000. In terms of how the tax charge is calculated, this is shown on the following slide. The NHS pension scheme only allows for the excess over the lifetime allowance to be taken as an income and therefore is subject to a 25% tax charge. However, this is not applied in one go, as there is no pension fund to deduct it from. The tax charge is applied by reducing your annual pension. In this example, the excess of £84,000 will be subject to a 25% tax charge. This figure is then divided by 20. You will note that this is the same factor as used to calculate the lifetime capital value of the pension. This tax charge is then deducted from the pension income. The cash lump sum remains unchanged. However, there is a way that Jim could have avoided this tax charge. Within certain limits, the NHS pension scheme now allows members to commute some of their pension benefits in favour of a higher cash lump sum, with the lump sum being increased by £12 for every £1 of pension income sacrificed. Just to recap on the value of Jim's normal pension benefits, a pension of 58,000 plus a lump sum of 174,000, resulting in a capital value of 1,334,000. But if Jim reduced his pension to 46,000 by commuting 12,000 of his pension income in favour of the cash lump sum, this would increase the cash lump sum by 144,000. The calculation would now be 46,000 times 20 plus a revised higher cash lump sum of 318,000, meaning a capital value of 1,238,000. As the capital value of the revised pension is now below the lifetime allowance of 1.25 million, he would avoid the tax charge detailed on the previous slide. The previous slides have outlined the current schemes and the tax rules, but there are changes on the way. If you think that it's likely that you may be in the fortunate position of having some of the tax issues with a lifetime allowance, the Treasury has previously offered some options of protecting the higher lifetime allowances. Unfortunately for many, the ship's already set sail in that the deadline for applications has already passed for primary, enhanced and fixed protection. However, if you already have pension benefits valued at over 1.25 million, as far as the NHS pension is concerned, this translates to a pension of £54,000 approximately, you will probably want to consider applying for individual protection, as this will provide you with a personalised lifetime allowance based on the lower value of your benefits at the 6th of April 2014 or 1.5 million. Importantly, with individual protection, you can remain an active member of the pension scheme, and the deadline date for applications is the 5th of April 2017. With regards to future changes to the public sector pension schemes, this started with a review which was carried out by the former Labour government minister, John, now Lord Hutton. He initially produced an interim report which was published in the autumn of 2010, with the final report being published in March 2011. The review recommended changes to the pension benefits of public sector workers. The changes will be implemented with effect from April 2015. So which schemes are affected? Well, although there are technically over 200 public sector pension schemes, they all follow a broadly similar benefit structure, with the largest schemes being the NHS, civil service, teachers, local government and emergency service schemes. So what has been recommended? First of all, and probably the most importantly, is that benefits you've already built up will be protected. Therefore, there will be two distinct parts to calculating the value of your pension benefits in the future. Part 1 benefits are the benefits you've built up before any changes are introduced, and Part 2 benefits will be based on what you earn after April 2015. Benefits will be based on your future average earnings. Also, your Part 2 benefits will come into payment at state pension age, which is planned to gradually increase to age 68 by 2046. Finally, we are told that what has been recommended will make public sector pensions sustainable over the long term, meaning that in theory we shouldn't see any further future changes for a very long time. I think that there's been a guarantee that this commitment is 25 years. So in terms of protecting what you've already got, the benefits accrued to date will be protected, and they'll be calculated in the same way and can be drawn at the same age as now. If you were within 10 years of retirement, as at the 1st of April 2012, there'll be no changes to your pension plan and you'll remain in the existing scheme. The changes do allow for some tapered protection if you were within 13 years and 5 months of normal retirement age, with the tapering effectively delaying the date of you joining the new pension scheme. As I mentioned earlier, for future service, your retirement age from your Part 2 benefits will be linked to the state pension age. State pension age is gradually being increased to age 68, but it is likely that this will be increased further into the future. So what does this all mean? There is a calculator on the NHS Pensions website that will allow you to produce personalised illustrations. However, if we look at a couple of examples, firstly for a 1995 scheme member. In this example, this 45-year-old had a projected pension at normal retirement age of £46,921. Under the new pension scheme, they'll have to work an extra 1 year and 173 days to achieve the same pension had they remained in the 1995 pension scheme. Alternatively, if they retire at age 60, they will attain a lower pension. Conversely, if they retire at state pension age, they will obtain a higher pension, albeit it is likely that they'll have been hit with the additional tax charges because they exceeded both the annual and lifetime allowances. Similarly, the results from the NHS pensions calculator for a 2008 scheme member. In terms of what happens next, the new scheme is due to start with effect from the 1st of April 2015. Full details of the scheme are now available on the NHS Pension Scheme's website. That concludes the first part of the presentation with regards to the NHS pension and tax changes. We will now have a look at what financial planning is and how it can help you. So we've run through how your pension works and how it can be taxed. So how does this affect your future financial planning? Now this might surprise you, but in my view, what we've been talking about so far isn't really financial planning. What I've been talking about is just noise and detail, which I need to understand, but in fairness, you probably don't. So maybe a good starting point is trying to define what financial planning actually is, well, in my opinion anyway. Financial planning is a process of developing strategies to assist clients managing their financial affairs to meet their life goals. The process of financial planning involves reviewing all aspects of a client's financial situation across a large breadth of financial planning activities, including interrelationships across often conflicting objectives. In my opinion, this happens to be a very good definition of financial planning. The only problem, and in my opinion, this is a little bit boring. So how would I describe what financial planning is? And how do we work with our clients? Well, let's have a look at our definition. Financial planning, done properly, is a process of helping clients live the life they want without the fear of ever running out of money, whatever happens. It's fairly concise, but it has a very clear objective. So how do we do this? At BHP, we use a bucket. So, welcome to our bucket. But before I explain what goes into your bucket, I'll outline some of the assets that remain outside of it in the first instance. Generally, all clients have one or more of the capital assets shown above the line. These assets may include your home, rental property, pensions and businesses, and some may also inherit some assets at some point too. Although these assets form part of your overall wealth, they are not easily spendable assets in that you have to downsize your home to release equity, you have to draw your pension benefits, or you have to sell your business in order to release the cash. We therefore keep them above the line as capital assets until we convert them into liquid assets. So when we look at a client's assets, we not only have to take account of their capital assets, but also their liquid assets too. And this is where the bucket comes into play. This is where we put all your liquid cash. In most cases, when income is received, it is paid into your bank account. But in the early stages of your working life, as soon as money comes in, generally it immediately goes out, paying for the cost of living. Over time, as your income grows, you are able to increase both the liquid and capital assets through more savings, and you may invest in other types of investments other than just cash. You will use your income to repay debts such as your mortgage or pay into your retirement savings throughout your working life. But at some stage you'll decide to retire, and at this point your salary or earnings will cease. At this point we will close off the expenditure tab as we move fully into the early stages of retirement. During this move into retirement, there are normally some major changes to your capital and liquid assets. Pensions are crystallised, the tax-free cash is paid out, and an income starts being paid. You may dispose of your business, or you may inherit money. Normally, there is a move away from your capital assets to liquid assets as the capital assets are liquidated. Your income stream also changes as you start to draw income from your pensions. Your state pension may start immediately or some years down the line, depending on the age that you retire. You may start using investment returns or capital to also supplement your income. Most clients go into retirement with some plans of expenditure, whether that's travelling, a new car or a holiday home. And we want to encourage this during the early years of retirement, because this is why you've worked so hard and saved so much. It's time to enjoy life. We want you to live the life that you want, to experience new things whilst you're still active and able to enjoy life to the full. And this is why we show a larger expenditure stream from your bucket. Unfortunately, time will come when you can't do as much as you once did. You can't or don't want to travel anymore, you don't go out as much, or your health doesn't allow you to. And normally, we find people start to slow down at around age 75 to 80, and their expenditure starts to reduce. At this stage, we turn off the early stages part of your retirement tab and turn to the latter stages of the life tab. During this stage, your pace of life reduces and your expenditure slows, generally to cut the cost of maintaining your property and general living costs, with maybe a few small treats along the way. Health issues may become more prevalent and long-term care may be required. But unfortunately, at some point our journey will end and the remaining capital and liquid assets will be distributed to the next generations. But when we look at all of the stages put together, one overriding question that each and every one of us will face is, do we have enough? Can I afford to retire? However, what we don't want to happen is that your bucket overflows by not retiring early enough or by not spending enough, as this creates further issues down the line, such as inheritance tax. If I can take you back to where we first started, to that initial question, what is financial planning? And if I can remind you of our definition, financial planning, done properly, is a process of helping clients live the life they want without the fear of ever running out of money, whatever happens. Let me explain how we do this and how we show our clients that they have enough. Well, we use a sophisticated cash flow analysis system which will help us analyse a client's financial position both now and into the future, given certain assumptions. The following few slides are screenshots from our system, but will give you an idea of how the analysis tool may help you. The first part of working with our clients is establishing what their current expenditure is and what they would like it to be into the future. This graph shows 3 distinct time periods up to age 60, which is when the client has chosen to retire. Up to age 80, when the client's expenditure reduces, and then to death, which we normally set at around age 100. The little yellow tabs on the graphs can slide up and down the graph to show different scenarios, such as what if I retire earlier. As the system is software based, the calculations, graphs are immediately updated and shown on the screen. It is designed to be interactive with the client. When we look at the analysis, if there is red visible on the screen, it means that there is insufficient income or capital to meet the client's expenditure needs. This immediately shows the client and us that they will need to reassess their expenditure or look at what they can do now financially to resolve the shortfall. Once we've established what the likely expenditure is, then we need to establish where the income is being generated from and where it is likely to come from in the future. In this example, each element of income is colour-coded to show the client their overall income flow and really how those are generated. The dark blue colour indicates employment income being earned through to the chosen retirement date. Light blue is other income. This could be rental income or investment income. When this client retires at age 60, they receive a tax-free cash lump sum from their personal pension, highlighted in pink, with the cream colour being the pension income from their personal pension plan. This client also has an occupational pension which pays out a cash lump sum of 3 times the pension at outset, followed by their yearly pension, which is a grey bluey colour. The orange colour highlights the state pension. As explained in the previous slide, the aim is to show whether or not they will run out of money given certain assumptions and objectives. As you can clearly see in this chart, there is still a shortfall highlighted in red. In this instance, to ensure that all the planned expenditure is covered, this client would have to use some of their capital from their liquid assets to supplement their income. In addition to showing the cash flow, the system is extremely comprehensive as it will show the effects of drawing income from capital. This chart shows how drawing capital down to supplement the income affects their liquid assets, but even doing so still shows that there is plenty of leeway for other forms of financial planning or increased spending. The cream colour in the chart indicates cash deposits from which capital is being withdrawn. The orange section of the chart highlights other investments such as stocks and shares ISAs or investment bonds. Generally, any withdrawals are shown to be taken from the least tax efficient savings in the first instance. In addition to the liquid assets outlined in the previous slide, we can also show all assets, which highlights the value of the client's property in grey and also the value of the pension in brown. Overall, the client can see the overall wealth including both the capital and liquid assets. However, having all this wealth brings into play additional issues to consider, such as inheritance tax, and the cash flow analysis system is able to demonstrate the impact of financial planning and the potential tax savings that can be achieved. Today, I have just shown you screenshots rather than the system working in real time. The system is designed to be interactive. We work with our clients on an annual basis, updating the information and advising them accordingly as their aims, objectives and circumstances change throughout their life. If you would like to discuss our services further, I have put our contact details on the final slide. Thank you for your time. I trust that the presentation was informative and of interest. Thank you.